Welcome to Gold Talk Show. If you've got that feeling, that kind of nagging sense that something big is shifting under the surface of global finance, even while, all the headlines are screaming about the latest tech stocks or crypto jumps, then, well, you're definitely in the right place today.
Absolutely.
We're about to do a deep dive into why gold might just be gearing up for a really significant move, one that could genuinely reshape how we think about wealth, stability, in the next few years.
Yeah.
You're probably here because you want to get the bigger picture, understand it quickly, thoroughly, and that's exactly what we're aiming for, a kind of shortcut to grasping these really crucial dynamics around gold.
And it's interesting, isn't it, that sense of something brewing? Well, the day-to-day market noise, like you said, grabs the attention. The sort of information we've been digging into, especially from Gold Talk Show itself, suggests a much deeper shift.
Right?
Our mission today really is to explore why this potential golden wave could actually transform finance and, how you might think about preparing for that.
Is gold really ready to, reclaim its throne as the ultimate store of value? That's the big question.
That's the core question we're tackling.
Yeah. Okay. So let's start with this idea. This quiet accumulation of gold, it really does stand out, doesn't it?
It really does.
I mean, for years you had tech booming, real estate going nuts, crypto doing its wild roller coaster thing. And gold just seemed to be sitting there quietly.
It's such a crucial point. And the data highlights this. During those exact periods, high growth elsewhere, major central banks, we're talking China, Russia, India, they were consistently buying gold. Net buyers for a long time now.
Yeah.
And it makes you stop and think, doesn't it? What do they see? What are they anticipating that maybe the wider market is just missing?
Exactly. Why gold? I mean, why pick an asset that looked, frankly, a bit stagnant compared to those potential huge short-term returns elsewhere?
Well, their game plan, it seems, is just fundamentally different from, say, an individual trader chasing quick profits. Central banks are thinking long term.
Stability.
Hedging. Exactly. Hedging against potential. Well, instability. Systemic shifts. They grasp a key principle. What shines brightest today can be the most fragile tomorrow. When the tide goes out, you see who's swimming naked, as they say.
Yeah. It makes you think of those classic examples, right? The U.S. housing market just before '08.
Oh, definitely.
The dot-com bubble back in 2000. Maybe even some of the hype now around AI, the metaverse. That initial, almost euphoric belief in limitless growth.
Precisely. And the information we're looking at really hammers home this concept of enduring value. Value tested across time. Gold, with its, 5,000-year track record?
Incredible.
It's consistently filled that role. It's tangible. It holds worth across different empires, different economic systems. I mean, think about it. A kilo of gold could get you a pretty good car 100 years ago.
And it still pretty much can today.
Remarkable, isn't it? That long-term stability is incredibly rare.
And yet it's easy to look at the gold price over the last, say, decade and think, okay, maybe its time has passed, it's flat.
But here's the kicker. Despite that lack of, headline-grabbing price action, central banks have been piling up physical gold at rates not seen since the late 1960s. Record levels, basically.
Right.
That difference, that divergence between the price chart and what the big players are doing, that's really telling. It suggests the smart money, the informative players, have been quietly shifting into gold. Maybe they see something coming that isn't common knowledge yet.
So looking back historically, has this kind of quiet buildup by central banks, has it often come before a big jump in the gold price?
That's a key historical pattern, yeah. Let's look at 1971. Nixon closes the gold window. The U.S. dollar is untethered.
Right, the end of Bretton Woods.
Exactly.
Yeah.
Gold had been fixed at $35 an ounce for ages. Within a decade, it shot up past $800.
A massive surge.
Huge. Then fast forward to the 2008 financial crisis. Gold was around, $700? By 2011, it nearly hit $2,000.
And the common factor in both cases was this period beforehand where gold was kind of off the radar. The average investor was looking elsewhere.
That's it, exactly. It's often when the crowd is distracted, chasing the latest hot thing, that the real groundwork is being laid for a major gold move. Which brings us to the why. Why do central banks see gold as this ultimate reserve? What's so special about it for them?
Well, it's not tied to any single government's promise, is it? It's not like a bond or a currency.
That's the absolute heart of it. Gold isn't anyone's liability. It doesn't need a guarantor. It
Right.
just is. It's independent. That incredible long-term stability, the intrinsic value recognized for millennia. That's something fiat currencies, government-backed money.
Which rely on trust and government decree.
Right. They can't always promise that same level of certainty, especially when global uncertainty ramps up.
It's true, though. Gold can sometimes feel a bit dull compared to the crazy ups and downs you see in crypto, for instance.
And that's a really important contrast. That allure of quick riches is powerful, no doubt, but those gains can evaporate just as fast in a crisis. Gold isn't about getting rich quick. It's about, well, safeguarding real value, being an anchor when the rest of the ship is rocking.
Which sort of leads us neatly into the current global economic picture. Because it really feels like there are some serious pressures building up under the surface. Inflation that won't quit, global debt levels that are just mind-boggling, and geopolitical tensions simmering everywhere.
The analysis definitely paints a picture of a system under strain. Global debt soaring past global GDP. Inflation that, many feel the official numbers don't quite capture the real pinch.
Yeah, the cost of living.
Exactly. It raises fundamental questions about the sustainability of a model built on ever more debt and, frankly, the ability to just print more money indefinitely.
It really makes you wonder, if things got really tough, a serious crisis, what would people trust more? A promise on paper or something tangible, something real in their hand?
That's the crux of it. The information suggests gold's value doesn't hinge on faith in this system or that government. It has value because it's always had value, everywhere. And if confidence in traditional systems starts to seriously crack, well, that inherent value could become absolutely vital.
So the central bank buying isn't just routine portfolio management. It's maybe strategic preparation.
It certainly looks that way. It suggests they see these aren't just normal bumps in the road, normal economic cycles. There might be deeper forces transforming the landscape.
And the information suggests the next couple of years could be particularly pivotal.
Yeah, the idea is that this convergence of factors, the debt, the inflation, the geopolitical risks, the shifting power dynamics we'll get into, it's creating a kind of perfect storm environment.
Mm-hmm.
And that confluence could force a major reevaluation of real assets, like gold, potentially driving its price far beyond what many conservative forecasts expect right now.
Okay, let's break down some of those key variables then, the ones highlighted as potential drivers for this gold surge. First up, persistent inflation. It definitely feels like things just keep getting more expensive.
And the analysis emphasizes that the official CPI numbers might not reflect the real cost of living pressures people face. Healthcare, education, housing, these often jump way faster.
Yeah, the base.
So in this view, inflation isn't just a blip. It's a slow, steady erosion of your purchasing power. And gold, historically, has been a pretty reliable shield against that kind of currency debasement.
Okay, variable number 2. The absolutely massive scale of global debt. The numbers are staggering.
They really are. The potential for global public debt to cross $300 trillion soon. That's over 350% of global GDP. I mean, it's almost unimaginable.
How do you even manage that?
Well, one likely path, unfortunately, is for governments to inflate their way out, print more money, devalue the currency, make the real value of the debt shrink.
Which hammers savers and anyone holding that currency.
Exactly. And gold, with its finite supply, you can't just print more gold stands in stark contrast. It can't be devalued in the same way.
Right. Third factor. This erosion of trust in the financial system itself. We've had some reminders lately that banks aren't infallible.
Yeah, recent bank wobbles, liquidity scares, talk of bailouts, it all chips away at public confidence. People start asking, how safe is my money, really? How stable is this currency?
And when that happens?
Tangible assets, things you can hold, things outside the system like gold, they naturally become more appealing. A safe harbor.
Makes sense. Fourth variable, escalating geopolitical instability. Sadly, it seems like conflicts and tensions are just increasing globally.
From Eastern Europe to potential issues in Asia, the Middle East, Africa, the risk of regional wars, major political crises, it feels higher than it has in a long time.
And history shows.
History consistently shows gold acting as a wealth protector during global turmoil. The key point here is, in a major global confidence crisis, no single fiat currency is truly immune. Gold, being stateless, not controlled by any one government, becomes uniquely valuable.
Okay. And the fifth key variable, this idea of shifting global financial power. It feels slower maybe, but profound.
It is. We're seeing this quiet, steady buildup of gold reserves by emerging economies. China, the BRICS nations, they're accumulating gold.
And trying to trade more outside the dollar.
Exactly. Reducing reliance on the U.S. dollar for international payments. It all points towards a more multipolar financial world emerging. And as the dollar's dominance potentially wanes, gold's role as a neutral, globally accepted liquid asset, well, it's likely to become even more important.
And those holding it beforehand would be well positioned.
That's the implication, yeah.
So it's really the combination of all these things, isn't it? That's the core argument. Not just one factor, but this powerful convergence.
Precisely. It's the synergy. All these forces working together could create a really strong tailwind for gold, potentially pushing it way beyond what people expect based on, just looking at recent history.
And the suggestion is many investors are still focused elsewhere, chasing short-term gains, maybe missing this bigger picture.
That's the idea. They might be overlooking this building wave, which potentially creates an opportunity for those who are paying attention, who are preparing. It really brings you to a fundamental choice, doesn't it? Are you focused on accumulating real lasting value, or are you chasing gains that might prove fleeting?
Which leads perfectly into the psychology of the crowd. That's another fascinating layer the analysis covered.
Oh yeah, it's classic market dynamics. History teaches us, again and again, the biggest opportunities often pop up when most people are skeptical or just plain indifferent.
Right, when nobody's talking about it.
Exactly. Think about past financial revolutions or big asset shifts. There's usually that initial disbelief, maybe even ridicule, before the value surge really takes hold. And the analysis points out how gold has been labeled, boring, outdated during these recent booms in tech, crypto, real estate.
It's almost like a contrarian signal in itself, the lack of hype.
It can be. And look at the stark contrast. The public may be yawning at gold, while central banks are buying it hand over fist at record rates.
That's a huge disconnect.
Huge. Remember the skepticism after 1971 when the gold standard ended? People thought gold was finished? Then it went up 20 times. Or during the dot-com mania around 2000, 2001, gold was seen as ancient history. Then it surged towards $2,000.
So there's this typical emotional cycle. Indifference, then doubt, then slowly belief creeps in, and finally,
euphoria. Extreme enthusiasm, often right when the best part of the move is already over.
And the people who follow the herd often get caught buying high.
They often pay the highest price, yeah.
Yeah.
Whereas those who did their homework, understood the fundamentals, and acted before the crowd. They're the real winners. So the question the analysis poses is, where is gold now on that psychological spectrum?
Still in indifference, maybe starting into doubt.
Possibly. Which, if history is any guide, could signal that a significant reversal, a major shift, is potentially on the horizon.
So the smart move, according to this view, is accumulating during these quiet phases, when everyone else is looking away.
That's the classic wisdom. Ignore the noise, ignore the fads, focus on real value. And the analysis argues gold is in that quieter phase right now, despite all these underlying risks bubbling up.
And the prediction is, once gold breaks certain key price levels,
then the crowd will likely rush in. FOMO kicks in. But they'll have missed the best entry points, the biggest potential gains.
So the bottom line here is really about conviction, believing in fundamental value and acting when others are hesitant.
That seems to be the core message. It's about being prepared versus being regretful. Do you want to be strategically gathering undervalued real assets now or chasing the frenzy later? Gold, the analysis stresses, doesn't need the crowd's applause to shine eventually. But you have the choice to position yourself before that potential rush.
Okay, let's pivot to the future then. The analysis lays out some potential scenarios for gold, really outperforming expectations maybe over the next, say, 3 years. And it sounds like we're not just talking about small incremental gains here.
No, the perspective is that we're at a point where these underlying currents could trigger something much bigger than just normal market cycles. These scenarios imagine gold not just rising, but potentially shattering conservative forecasts, maybe even rewriting its role in the global financial order.
And the warning is, don't miss this potential historic shift by simply not being ready.
That's the underlying caution, yes.
Okay, scenario 1, gold surpassing $3,000 USD an ounce. What's the thinking behind that?
This one's tied pretty directly to prolonged inflation. It would be higher than official targets, and just a continued gradual decline in faith in fiat currencies. Think about the sheer amount of money printed globally, the colossal debt levels.
Yeah, we covered that.
As trust in paper money slowly erodes, as its purchasing power visibly shrinks, gold becomes that primary safe haven. Soaring demand meeting limited physical supply. That's the dynamic that could drive prices significantly higher, potentially past $3,000.
Okay, scenario 2 is even bolder. Gold hitting $5,000 USD, maybe even higher. What would need to happen for that?
This scenario envisages a much deeper restructuring of the whole global monetary system. Maybe the US dollar loses its dominant reserve currency status. Maybe the BRICS nations or some group actually launch a credible payment system backed by hard assets, including gold.
A major reset, basically.
Exactly. The world would desperately need a neutral, trusted, unmanipulatable store of value. Gold is the obvious candidate. This wouldn't just be a price increase. It would be a systemic repricing of gold, reflecting its fundamentally new central role, much higher than historical level.
Okay, scenario 3, a new generation of global financial crisis. How does gold fit in there?
Well, imagine a crisis where confidence collapses not just in one sector, but broadly. Stocks, real estate, maybe even the more volatile cryptos, all take a massive hit simultaneously.
A flight to safety on steroids.
Precisely. Gold, as the asset of last resort, would likely see colossal capital flows pouring in. Not just individuals, but big institutions, pension funds, even governments scrambling to preserve wealth. The analysis suggests a gold rush then could be faster, stronger, more intense than anything we've seen before, just because the global economy is so much larger now.
Makes sense. Scenario 4 is interesting, a shift in global investor psychology. Tell me more about that.
Well, for decades, investors got used to low interest rates and the idea that central banks would always step in to save the day, the central bank put.
Right.
What if those tools stop working effectively? What if inflation stays stubbornly high despite high interest rates and debt problems become unmanageable? Investor psychology could fundamentally shift. Instead of maximize returns at all costs, it becomes preserve capital at all costs.
Survival mode.
Basically. And in that mindset, gold isn't just an investment, it's almost a survival strategy. Its appeal skyrockets.
Okay, and the 5th scenario, a long-term structural shift. Away from paper assets, back towards real assets.
Yeah, the 20th and early 21st century saw this incredible boom in financial assets, stocks, bonds, derivatives, relative to tangible things. The argument here is that this paper asset bubble might be reaching its natural limit.
A return to basics.
In a way, a return to real value. High-quality real estate, essential commodities, and especially physical gold could become the new focus of global capital. Not overnight, but a decades-long process reshaping asset markets.
These are definitely some powerful scenarios to consider. It brings us back really forcefully to that central question you posed. Are you truly ready for a major market upheaval?
It prompts a reflection, doesn't it? Think about past market breaks, 2008, 2000, even earlier ones. They often seem to come out of the blue for most people. Contrast those who were prepared, who had diversified into real assets, with those who were caught completely off guard.
Swept away by the storm.
Yeah. And the analysis argues the warning signs now aren't subtle anymore. Central banks buying record gold, global debt off the charts, quiet moves towards a new monetary order. These are flashing yellow, maybe even red.
So it's about preparation before the storm hits, not during.
Absolutely. Waiting for absolute undeniable proof usually means you've waited too long. The best opportunities are gone. Being ready in this context means understanding the risks, intelligently reallocating some assets, maybe gradually accumulating physical gold while it's potentially still undervalued.
Building defenses proactively.
Exactly. And maintaining a steady mindset. Not panicking, not chasing hype, but acting deliberately based on your understanding of the long-term picture.
And what if the big upheaval doesn't happen right away? What if it takes longer?
Well, proper preparation, including holding an asset like gold, still provides stability. It offers diversification. Gold is a long-term store of value, not a get-rich-quick lottery ticket.
Right.
So the conclusion seems to be, whether the major break happens soon or further down the road, gold looks poised for a much bigger role. And those who patiently accumulate, who have that long-term vision, they'll likely be the ones best positioned, whatever the future holds.
That's a powerful note to end on. Thank you for walking us through this really deep and insightful analysis.
My pleasure. It's certainly a critical time to be thinking about these forces.
And for everyone listening, if you found this deep dive valuable, please do give us a like, share it with anyone you think might benefit, and definitely subscribe to Gold Talk Show. That way, you won't miss any of our latest news and insights on gold.
And maybe take a moment after this to really consider, your own readiness. Think about the long-term role gold might play in your financial future. It's a question worth mulling over.